Hello, and welcome to today's webinar. I know that we'll be discussing everything over Zoom today, and so as fun as that is, I hope we can provide a little bit of entertaining over this awesome discussion that we should be having over the next hour or so. We will be discussing ministerial and clergy tax planning today, so all the fun topics that everyone talks about at parties and whatnot. My name is Travis Brooks, and I'm a CPA Fouts Morgan CPAs. I've been practicing in tax for about 8 years now here in Memphis, and I look forward to speaking with you today covering these topics. I know a few of our representatives should be included in this Zoom call today to answer any questions during the broadcast and after. I sadly will not be able to attend on November 16th, but I look forward to everyone's feedback regarding the information that we've covered today. So let's get started on our discussions today. And what we'll be covering is 1099 versus W-2 income for ministers, Schedule C deductions that you should be aware of and how you should be taking those into account, quarterly estimates for the taxpayer, Social Security, housing allowance, maximizing your deductions, and amended returns and accountable plans. These all can impact minister and clergy income throughout the entire year, so it's something to be aware of, and it's good that y'all have shown interest in these topics to kind of plan ahead because you never know around tax time in April, everyone kind of gets all the information that they needed to do in the years prior at that time. So if you're thinking about it during the actual year, you're doing something right. All right, so we'll be packing all of these in for maximum entertainment value for you. So let's start with 1099 versus W-2 income. When are you an employee versus being self-employed? What is the tax impact of being self-employed? And so we'll start off talking about if a congregation employs you, you earn salaries and everything like that, you're a common law employee. That income will be reported on a W-2. And this income has some ramifications because as an employee, you don't get to take any fancy expenses throughout the year. These amounts are taxable. You can have withholdings put on them, and as a minister, you can actually elect to not have any withholdings on your W-2. I would suggest you do, though, as W-2 withholdings are not subject to timing as quarterly estimates are. And if you're expecting to owe at the end of the year, it's going to have something withheld so that you're not chasing after money in April trying to make a payment. Amounts received directly from members of the congregation, such as fees for performing marriages, baptisms, and other services, are not wages because these are outside services of the actual church, and these will be subject to self-employment tax. This is where the fun begins. Those would be issued to you on a 1099, and thus you would be able to take any business deductions that you incurred during performing those services. All right. So a licensed, commissioned, or ordained minister is generally a common law employee of the church. To provide ministerial services, there are some exceptions, such as traveling evangelists who are independent contractors under the common law. Anything that is independent of the church is going to be on the Schedule C, 9 times out of 10. So you will be claiming that income as a separate entity from your employment and thus being able to take your expense on it. I will repeat myself a few times because this is kind of covering the same basis, but we got to make sure that we get it all. Regardless of whether you're a minister performing ministerial services and as an employee or self-employed, all of this is taxable. Pretty much money in is taxable unless it's a gift. But so you just got to make sure that you're covering yourself. Like even if you're just withholding your normal tax rate, you got to be thinking about self-employment taxes. Ministers aren't subject to FICA, but they're subject to SECA. So one way or the other, you're going to be paying Social Security and Medicare tax. So wages would be reported on the W-2 and would be reported on the page 1 of the 1040 on line 1. Since the Tax the Tax Cuts and Jobs Act of 2017, any unrelated business expenses are not deductible for the employee. So you're not going to be keeping up with receipts or anything like that unless you're a part of an accountable plan where you get reimbursed. Income earned outside of normal church responsibilities would be reported on the Schedule C. I think I've said that at least 3 times, but we are making sure that we are doing this correctly. So I've provided an example of the Schedule C, and 9 times out of 10, you would be putting your income on line 1. And then you would have appropriate expenses in part 2. Anything that's associated with the business, 9 times out of 10, you can deduct. Only thing you wouldn't be subject to would be like penalties or uh, not the case of 21 and 22, but like half of your meals and things like that, and choosing between actual auto expenses versus mileage rates. So this is where you would put everything. You could also attach to the Schedule C your business use of home deduction. However, it gets complicated with the housing allowance for ministers. But depending on your taxpayer and how things are going, you got to weigh out the good with the bad and see what maximizes the tax liability at the end of the year. But as you can see, all this is reported. Then you have other expenses that need to be listed out in a statement that is attached to the Schedule C. So anything that's not expressly written here, but was incurred, or if you want to list out specifically, and if it's, you don't want a huge number in office expense, but you want to itemize everything out, you can put those under line 27A for other expenses. So 1099 earnings, these are income from Form 1099 is subject to the self-employment tax. Ministers must calculate their self-employment tax on Schedule SE. So any income coming through on Schedule C, rental income, anything like that, and if it's subject to the self-employment tax, you will have a Schedule SE. And although the minister excludes the housing allowance from gross income, the minister must include the housing allowance in their self-employment income calculation. Self-employment tax is covered under SECA and is used to fund Social Security and Medicare. The IRS permits taxpayers to deduct half of the self-employment tax on as a business expense. So you'll see a line on their return where half of that is deducted. And this is sort of because they're self-employed, so they don't have an employer that's paying half of the SECA tax for them, or the FICA tax at that point. W-2 earnings, ministers are exempt from federal withholdings, but they can voluntarily have withholding on their W-2s. I would highly suggest doing that. Quarterly estimates, you have to make sure that you pay them on time and throughout the entire year, and you got to make sure that you're spot on the money. W-2s, you can throw on the withholdings at the end of the year. It counts it as the entire year. So if you're in a bind at the end of the year, you can always use your W-2 to kind of catch up and make sure that you have enough withholding during the year for your ministers and whatnot. Let's see. Okay, so let's talk about the Schedule C deductible expenses. So on the income that church employees or these ministers are earning outside of standard employee income, they can take expenses on the Schedule C against this income. So beginning in January of this year, in 2021 through 2022, the 50% meals deduction has now changed to 100%. I think they're trying to get more people into restaurants and back into the service industry. But this is a big advantage for folks who travel around the country or travel across states or just travel all across the cities to be able to maximize the amount of expenses they get, because all of their food is deductible at this point. If it's on their own getting this income, then they get to take the entire thing as an expense. Then on their Schedule Cs themselves, we're looking at any reasonable expense really that is incurred trying to earn this income will get you a deduction. Now, your penalties and anything of personal use, like going to the movies after you After you've finished a wedding, that doesn't count. You can't deduct that. But, your mileage or your gas, one or the other, any advertising that you're trying to incur to get this income, you can take that as a deduction on the Schedule C. Um, Ministers could also take the business use home deduction. I don't really think that this will ever be taken, but I just want to at least tell y'all about it is because a portion of their home, if that's their place of work for these outside services, they could potentially get a deduction based on their square footage and any indirect expenses for keeping the house up. But with their exclusion or their housing allowance on their W-2, you can't double dip. So it's one or the other, really, or to a certain extent, like that you take your business use of home deduction, you would have to reduce your housing allowance over on the other side. It just is up to each taxpayer on what would be more advantageous. So if they have a very low housing allowance or something like that, you could possibly try and play around and maximize it. But I just wanted to let you know if someone's trying to produce Schedule C and they have a home office and they're like, "Can I take this deduction?" You more likely than not will just tell them, "No, you can't double dip. You have a huge housing allowance. You don't need to mess with that because that could complicate things and also make you more or owe more tax." So, ministers should keep track of all related expenses to outside business that will be reported on the Schedule C. So any of your expenses, I mean, a lot of the times you can get away with an estimate, but you really need to keep up with really good records. You need to keep an Excel spreadsheet or uh, a little QuickBooks online account and put everything in there that you can think of to be able to help you get the maximum amount of expenses against this income. Um, so your mileage, so travel when you travel, you can either take your mileage rate or you can take the actual expenses. And when you decide that, that's kind of the decision that's going to follow you for the entirety of that car. So you'll list the auto and you will either take all the gas, all the repairs in the car, everything like that. Throw a little bit of a personal percentage on there depending on if it is a fully business use vehicle or a mix and match. Just depends on really how much they travel it themselves because, if they're not traveling over state lines or anything like that, the gas and the repairs and everything like that may actually be more than how much they're getting back in mileage. So something to, you know, ask your tax advisor on a specific by specific basis to be able to come up with the correct answer for your taxpayer. All right, so let's talk about quarterly estimates. Quarterly estimates, we need to be making, 4 times a year, obviously, but as you're incurring income and you're not having any withholdings on it, and this goes for W-2 and 1099. So since they're excluded from or exempted from having federal withholdings, at the end of the year, if they haven't done anything about that, they're going to have a huge tax bill in April, depending on how much income they have, especially if they have investments on the side as well. So this way you can kind of keep up with uh, everything and split the burden across the entire year, and also prevents you from having any interest or penalties at the end of the year. So taxes must be paid as you earn or receive income during the year, either through withholding or estimated tax payments. As I said earlier, withholdings on a W-2 count as being made throughout the entire year. So if the amount of the income withheld from your salary or pension is not enough, and you receive income such as interest, dividends, all these extra things, you'll have to make estimated tax payments because that is income. And a lot of times that income is not withheld on. So if you don't have to, and below this is where, you're not going to get any penalties or interest because of these 3 things. If you had no tax liability for the prior year, you're a U.S. citizen for the whole year and your prior year tax covered a 12-month period, you're exempt. You're good. But that's typically not always the case, especially with people that make good money. And probably not why you're here if you're worried about someone who's not making, income to pay a tax liability. Why would you be watching this? So typically your wages should have enough. 9 times out of 10, you'll have it covered with a little bit of extra cushion. But for folks that have these Schedule Cs and investments and everything else added on top of retirement distributions and whatnot, you'll need to cover that income. The income the taxpayer makes during the year for services outside normal church activities, they're not going to have any withholdings, so you got to make sure that you are covering yourself. Let's see. Yeah, so on your Schedule C, I mean, you're not looking at the base receipts that you're receiving to calculate your tax burden at the end of the year. You're looking at your income minus your deductions, and then that would be subject to your self-employment tax and income tax. So you're getting hit twice on those. All right, to avoid penalties, you can avoid penalties if you owe less than $1,000 in tax after subtracting the withholdings and credits. And if the taxpayer paid at least 90% of the current year's tax or 100% of the last year's tax. A lot of times you'll see people produce estimates solely based on the current year's tax, make them pay the 100%, less whatever their withholding was for that year, just to make a good estimate so that they're covered by the end of the year. And the taxpayer should be having discussions throughout the year to be like, am I covered? Am I going to get hit with a, huge penalty if I'm not paying these estimates on time? They should be aware of that. The impact could get huge depending on how much income they have during that year. All right. Also, to cover this, self-employment tax. If they have a substantial Schedule C, if they're the number one minister producing or performing marriages throughout the entire year, you need to be aware of that. Be sure that they are covered on their self-employment tax. Their earnings are subject to the self-employment tax, and that tax rate is 15.3%. And then half of that will be a deduction that's not credit against the tax. It's just a deduction against their current income. So they will be paying that. It's just to help out just a little bit on the self-employment side, because typically the employer would be paying half and the employee would be paying half. And since they're self-employed, they're getting hit with the entire bill. All right, so we'll talk about housing allowance here. Minister's housing allowance. A lot of times I'll hear all the different names for it. It's either parsonage, I can't even speak, the rental allowance or the housing allowance. It's the excludable part of their gross income for their housing. And so if they receive a part of their salary that is an amount officially designated for housing, it's subjected to these limits. And it's you can exclude from your gross income the lesser of the following. It's either the amount officially designated in advance as a housing allowance, or the amount actually used to provide or rent a home, or the fair market value of the home. So these payments officially designated as a housing allowance must be used in the year received. I'm cutting off received, but that's received. You can trust me. So it'll end up being the lesser of one of those three. And so you got to make sure that they're keeping up with their expenses. You have good records of what you're designating as the housing allowance, and check up on the appraisals on the house to make sure that you are not messing this up. All right. And so if the congregation furnishes the house in kind as pay for the services as a minister instead of a housing allowance, you can exclude the fair market rental value of the housing from income. But again, you must include the fair market rental value in your earnings from self-employment. All right. So let's talk about maximizing deductions. I feel like I'm trailblazing through this stuff. Is everyone still with me? You guys can't respond, but I feel like y'all are here. So, keep records. You don't know how many times I've asked for people and they're like, what can I deduct? I was like, what do you do? Hmm? Where do you spend your money in this business? A lot of times I always like to have clients keep a separate bank account for their business side of things because it makes it a lot easier to sift through personal and business because everything in the business account or the business credit card should be for business. Um, I shouldn't be seeing Malco. I shouldn't be seeing, um, you know, school tuition or anything like that. So just keep good records. If you're, if you like pain, set up an Excel spreadsheet and keep up with it throughout the entire year. Otherwise, get like a quick QuickBooks online account, throw it on your phone, you'll be good to go. Keep records of every expense related to work outside the church. Look over these records multiple times a year. Just make sure that you're catching everything and that your income every month looks right. You worked really hard in January, but you didn't work a lick in February, so you shouldn't have any income in February, but you definitely incurred some fixed costs like utilities and your phone bill and everything like that. And also make sure you're keeping up with, if they have one cell phone, but they use it half the time for business, you take half of the uh, phone bill as a deduction. So make sure you're paying attention to what they're actually doing throughout the day and how they manage uh, their income or their business side of things. So if the taxpayer is looking at a high amount of income, which would be subject to self-employment tax, we should play a game where every time I say self-employment tax, everyone groans. But it's one of those scary things that, people are surprised at the end of the year that they are subject to. The taxpayer could obviously purchase new fixed assets. Um, a lot of times you don't even have to throw them on the fixed asset schedule. They're under 2,500 bucks. You can expense them as repairs, just new computer, 1,200 bucks. Um, if they had a good year full of income, advise them to get a new computer. You know, if they're trying to maximize, keep going forward, and they have an old computer from 2008 or something like that, maybe push them to get a new one or a new phone or something like that. You could expense it. Don't get frivolous with it, but if you have income and you're trying to reduce your tax load and you need these things, go ahead and get those things for you. Treat yourself. Uh, and then on the outside of the Schedule C, to maximize your itemized deductions, and they're trying to make a big charitable contribution at the end of the year or something like that, that could help reduce the liability. However, all of their itemized deductions should go past the threshold of the standard deduction. So, any dollar for dollar after the standard deduction, you get to start claiming those itemized deductions. Um, and again, it's all subjective and covers each taxpayer differently. Also, in one thing that I think has gone the wayside because Roth IRAs are so popular, traditional IRAs offer a tax deductible contribution. So they get paid and they have all this income and they want to throw it into their retirement account. If the taxpayer is eligible, the taxpayer may want to make a retirement contribution to reduce current year income. Be aware when the distributions from these IRAs are incurred, the taxpayer will be subject to income tax on those distributions. So make sure they're withholding on those. A lot of times I see IRA distributions with zero withholding, and that always makes me eye roll because they knew that they were going to owe tax on it, so I don't understand why. The total contributions for 2022, 2021 is $6,000. For your traditional IRA. And there is a limit on your modified AGI, so that's modified adjusted gross income. and this will impact the amount of contributions eligible to be deducted. So it just depends on their income level. Here I've shown a fun little slide. It was recommended on the side, so I clicked it. I felt smart. But if your filing status is single and you're making 66,000 or less, and since a lot of that is excluded due to housing allowance and you're maximizing your deductions on your Schedule C, you can make a full deduction or contribution. And then, I mean, you can still make the contribution, but you don't get a deduction after these levels, and you get a partial reduction if you're making more than 66 and less than 76, and if you're making 76,000 or more, you get no deduction. And then for married filing joint, it goes up to 105 or less and with a full deduction, and then anything above that, you get a partial deduction. So you can just kind of, and a lot of these tax softwares can actually, maximize what they should make, and they can make that by the due date of the return to count for the previous years. Amended returns, always my favorite things. These currently can only be paper filed, and depending on the state of the world at the time, they'll sometimes allow for faxing and electronic upload, but it's very rare. Amended returns are when you fix a boo-boo. Someone made a mistake on a return, someone didn't provide the right information, and either you get a good benefit or you owe a whole bunch. Depends on what happened. All right, so they may encounter a change from a prior that needs to be corrected on that year's tax return. Taxpayer would need to file a Form 1040X. 1040X is a pretty flat form. You got one page, actually two really, but the main page is what's important. You give a little description of where the boo-boo occurred, who's got to fix it, what fixed, what changed, what forms were impacted. Just one big record-keeping nightmare. But it's easy for the taxpayer. They just sign it. Tax preparers are the ones that need to make sure that we're including everything. And also that the people who are managing everything for the minister has everything for them. 1040X is used to correct the Form 1040 and all the other smaller ones depending on what was originally filed. You can make certain elections after the prescribed deadline. There's limits to that, obviously. Some can, some can't. Any changes that were adjusted by the IRS, during the filing year itself. And, you need to be making sure if they owe extra on the 1040X, they are including any interest or penalties on the 1040X. And I'm blocking out the last one again. I'm just here to make it hard for you to read. But I'll read it out. So you can make a claim for a carryback due to a loss or an unused credit. However, you may be able to use Form 1045 for an application for tentative refund instead of the 1040X. That one's a lot easier. That one's for NOLs. And so if you don't want to go through the hassle of filing the 1040X and everything along with it, Form 1045 is very helpful and very easy. All right. So, when you file 1040X, 1040X can only be filed after you've filed the original return. That's obvious. I don't know why the IRS wants to state that, but just to cover myself, I'm making sure I'm stating that. And generally, for a credit or refund, you must file a Form 1040X within 3 years, including your extensions after the date that you filed your original return, or within 2 years after the date you paid the tax, whichever is later. If you filed your original return early, your return is considered filed at the due date. So your real OCD folks that get their stuff in January 30th with their W-2s and everything, they're ready to go. They filed it on middle of February. Their statute of limitations starts April 15th of that year. However, if you had an extension to file, but you filed earlier and they received it by July 1st, they are considered filed on July 1st. So that's when the guys that wait until October 15th to give us everything, they have a big advantage because they have the latest statute of limitations to get amended return. However, 9 times out of 10, they don't bring enough for 1015 to be able to do enough. So, just kind of where your risk profile lands. All right, so with the 1040X, you can't just send in a piece of paper and they go, okay, we believe you. That's it. You need to provide enough written or paper documentation to justify your changes. So you need to assemble any schedules and forms behind the 1040X in the order of the attachment sequence number shown in the upper right hand corner of the schedule or form. I'm just going to move me. There we go. If you have supporting statements, arrange them in the order of the schedules or forms they support and attach them last. Don't attach a copy of the They say this. They say don't attach a copy of the original return correspondence or other items unless required to do so. I am in the vein of attach as much information as you can so no one can ask a question and delay the process any further. So that is a subjective thing based on whoever is doing the amended return, but at the very least, attach any change forms like K1s, 1099Rs, W2s, anything like that that has been amended. You need to attach those so that they see them, and any extra expenses that are picked up on a Schedule C. Someone he found extra credit card, and you want to pick up those extra expenses, attach a credit card statement or anything that's going to provide ease for the person processing the 1040X to be like, that's right. That's good to go. We'll make that change for you. All right, let's go to the next one. Now my big head is in the way again. We're going to go down here. All right, so here is the actual 1040X. So we have our original amount in column A and a nice little add subtract function in column B and the correct amount in column C. So they don't have in the income and deductions block right there. They don't have the specified, wages or Schedule C income or investment or anything like that. So you're going to have to specify on the second page in the description of why it's changed, where this change in AGI is coming from. So it's like, original amount was $0, and then the net change is $15,000, and the correct amount is $15,000 worth of income. In your description at the end of the 1040X, you would say, we added $15,000 more of income because 1099R came in late. And it wasn't our fault. We're just reporting it correctly. And we've attached a copy of the 1099R on the back of this 1040X. And down the bottom, it'll show, no change on any withholdings, anything like that. But, and then it'll calculate your new tax or your new refund depending on what changed. And any interest and penalties down at the bottom. 9 times out of 10, the tax software will help you out a little bit and calculate those interest and penalties for you. If you don't put them on the form, and they'll send you a notice in the mail saying, we've calculated your interest and penalties on your 1040X. Thank you so much. Send us a check. So, all right. So where do you send your amended return? It's a paper copy. I can't sit there and fax it into the number. So, if you live in these states, Tennessee's up at the top, you're going to be sending these to Kansas City, Missouri. And depending on who's filing where they live, where it's being sent from, etc., they have different processing centers for each state, and they kind of all flood into the same place. Also, if you get a notice and you need an amended return, and they specify send an amended return to this address, check with your tax preparer, but you should probably send it to the address that they tell you to um, in that situation. That's it for admitted returns. That's as fun as it gets. It's where someone's in trouble and you're trying to fix the mistakes of whoever is in trouble. It's always fun. Or someone forgot to include something and they're going to have a great day when the answer is a big refund. Just depends. It's always a whirlwind of emotion. You never know. All right. So we're going to end around here on accountable plans and what we're summarizing everything that's going on for tax planning for these folks. So accountable plans are really beneficial nowadays because there's no more unreimbursed business expenses. This allows for businesses to be able to take an expense whilst reimbursing the employee, so they don't necessarily get a tax benefit from spending the money, but they also get their money back. And the tax benefit's only up to their effective tax rate as an impact. So it's honestly better for them to get money in their pocket. So let's get some more information than just me rambling in a big title screen, maybe. All right. With changes arising from the Tax Cuts and Jobs Act, I cannot say that fast enough. Unreimbursed expenses would no longer be able to be claimed by employees of businesses. Unreimbursed business expenses are a 2% floor deduction of yesteryear that a lot of people, especially sales reps, lost out on. And an accountable plan allows for employees to be reimbursed for expenses related to their current business. My head is in the way again. Let's move me over. Accountable plans may include reimbursement for a number of different employee-related expenses, including travel expenses, purchase of tools and equipment. I don't know if that's happening a lot in the ministerial space, but we're going to discuss it. Employee home office expenses. So beforehand, the business use of home used to be a big deal for people working from home, and conveniently, they took that out a few years before everyone was working from home. So it'll be interesting to see how that goes, how that if that sticks, if that comes back. Um, your mileage costs, required uniforms not suitable for an area where your dues and subscriptions and job search expenses for employees who have been laid off. Used to you be able to take those, no, you can't, but an accountable plan allows you to take these. So in order to be considered an accountable plan by the IRS, the arrangement must include all of the following. Expenses must have a business connection. That is, they must have been paid or incurred while performing services as an employee. The employee must adequately account for the employer for these expenses within a reasonable time. You must require employees to provide you with detailed information on these expenses, including date, time, place, amount, and business purpose for the expense. You must require the employee to return excess reimbursements within a reasonable and specific period of time, depending on the circumstances. And if the employees are not required to return the excess amounts, they must be included in their income. I didn't announce it this time, but I had to move. My head was in the way again. All right. So using an accountable plan has its advantages if you meet the criteria to do it. So that's why it's important to meet that criteria so that you can do it. Reimbursements from an accountable plan are not treated as wages to the employee and are not subject to employment taxes. So that, and these can drain cash from both the employee and the employer because they would be subject to Social Security, all that fun stuff. And accountable plans allow for the employer to deduct the expenses that they are reimbursing, allows for the reimbursement to be tax-free to the employee. So you send off one of your ministers out, and they go to a conference or something like that. They spend a bunch of money on meals, everything like that. They turn in their expense report. You reimburse them. You get to take the expenses, meals, which is 100% deductible in the current year. and then the employee gets to get their money back that they spent, at that big conference or whatever. So it is very helpful, and they don't get to pick it up as income because they did something for the business. And beforehand, these weren't, you know, you couldn't take the expense on your personal tax return, so all these people are really itching to be able to get reimbursements and all that. And all right, so we've trailblazed through everything that we want to cover today. There's a few, hits or misses. Just wanted to make sure that everyone got everything covered that they wanted. So there's going to be a question and answer time after this. Just remember, on your W-2 folks, on that side of the business, they are exempt from withholdings, but it is very beneficial to do withholdings. I don't think anyone would say it's not, unless they don't want to talk about their income tax situation, and the entirety of it is, that they say they're fine, let them be exempt. But it sure is a lot easier than keeping up with quarterly tax estimates. If they know that they're going to pay, 20 grand in tax one year or this year, and that's what they paid last year, you would be covering 100% of last year's tax by withholding that amount from their W-2, and then they wouldn't have to worry about their estimated tax payments. So I don't know. That's one of my biggest sticks for everyone to have. And then also make sure that they are keeping up with their expenses, their housing expenses, so that everyone that is involved is safe on what they're doing with the amount of allowance that they're giving out and what the actual minister can take. And, just be aware of the accountable plans, and if you need to make an admitted return, feel free to always reach out. You can reach me at tbrooks@foutsmorgan.com, or you can call the office, and I'll be happy to answer any questions for y'all. And I know that we have folks here in the actual meeting that would be happy to answer for you. So I appreciate everyone's time. I hope you guys have a great day. Have a good holiday season. Think about us in March and April, and we'll hope to see you again. Appreciate you.